Want to buy investment properties, but your tax returns don't show enough income, or maybe you don't qualify with your current W-2 income? This is where a DSCR loan can come in. And if you're trying to build rental income, you need to know how this works. DSCR stands for Debt Service Coverage Ratio. Now don't let that fancy name lose you. Here's the simple version. The lender is not using your personal income to qualify. They're looking at your property. The main question is, does the rent cover the mortgage payment? That's it. If the rental income supports the payment, the deal will work then. So instead of using tax returns, W-2s, or self-employment income, the underwriter looks at the property's rental income. That rental income usually comes from rental comps provided by the appraiser. Then they compare that rent to the mortgage payment to see if the deal works. Now, this is not free money. You still have to qualify. You need a 640 middle credit score, and you need 20% down. So yes, you need credit, and you need down payment money. And the property has to make sense. But here's why investors like it. You may be able to buy a rental property without verifying your personal income. That's big for self-employed buyers, business owners, and investors whose tax returns don't tell the full story. It also applies to those who are W-2 wage earners. And let me be clear, this is not for your primary residence. This is for investment properties only, such as rental homes, duplexes, and other investment type properties, depending on the program. So before you think your tax return killed the deal, you may just be looking at the wrong loan. DM me DSCR, and I'll show you how the numbers work. I'm Money Mike, keeping you informed.